Welcome everyone to the Pump and Dump channel. Today I would like to talk about negative yielding bonds in the Eurozone. There's been a lot of chatter of course in the news, and also on YouTube there's quite many people who are talking about this topic, and there's this misconception I've seen that's been propagated that people owning bonds are essentially paying the government for this privilege of owning bonds. And of course there's other stories saying that people are seeking safe havens and they're willing to take a small loss on their bonds rather than being in cash or being in other equities or other riskier securities, which is of course nonsense, because if you can put money into cash, why would you put money into bond if you're going to lose money in a bond, whereas in cash you can just, get nothing. So this misconception we need to address here in this video. First thing to talk about is how does the market really work when we're dealing with bonds. There's the primary market, which is essentially when the banks are dealing with government. Usually it's the banks dealing with the government, and the government, they receive money from the bank, and the banks receive the bond in exchange, which has a coupon. And I'll take the German bonds here example. It's a very good one. We have this 30-year bond that has a coupon of 125. The current price is 142, and that implies a negative yield of 0.18%, which means that at the end of the maturity you get back the par value plus all the coupons. Over the 30 years you're going to get less money back than this 142 that you are paying now. And okay, so the governments usually when they're issuing a bond, it's at par value, which is 100. So the banks are essentially buying this bond at 100, getting the coupon, and then they go to the secondary market, which is dealing with people like me, and they're trying to sell me this bond for 142.47, which is marked to market based on the current yields in the bond market, which are these. So that's kind of how the market works. You would say like, wow, they can just buy a bond for 100 and then they can try and flip it for 142, and that's a great business model, and indeed it is. Of course, how does this come about, this 142? There is some argument that people say, well, the governments are less risky, especially like Germany has strong tax revenue, they're not spending so much, which is of course why their school buildings are collapsing and in bad shape, and their infrastructure in general is also deteriorating. So fiscally and financially the German government is standing there very strong, but they're not investing enough into maintaining their infrastructure, so they have some problems really, but that's not really the thing right now. Of course, if the German government would issue lots and lots of new bonds to raise money to fix all of its broken infrastructure, then of course the yields would go up, because then there would be like a flood and there would not be enough money to absorb all of this debt. So what can I talk about next? Some people have likened these prices to a Ponzi scheme. I think that you can make the argument, but it's kind of the same thing that happened in the housing market. People looked at historical returns, and when, especially like with bonds, when you see like let's say the yield was at exactly zero, you could say like it's gotten to its full value, there's nothing more to get out of there. You can then say that at that point, what kind of valuation systems, what kind of pricing models can you use going forward, because the banks, they want to own these assets, and they want their assets to go up in price every single year by a certain percentage. And if you use like historical returns, you can then just in some way argue that last year it was let's say 139, and this year we want three euros more for our bond because historical returns have been so and so much. You get to this point where there's like no valid argumentation, and then you just resort to rule of thumb, and that's kind of what I think has happened. Some people, of course, they point to like Deutsche Bank and they say, well, they're kind of looking insolvent, their share price has collapsed, and they need to prop up the asset prices that they of the assets they hold, which is of course in some way, lots of it is probably German government bonds, so they need to prop up those assets to meet their liabilities so they're not insolvent. So yeah, let's go to some news here. I found this. Germany prepares to sell 30-year bond with no coupon, which would then bring these coupons all in line at zero. And if you think about it rationally, why are they why like banks accepting a bond with zero coupon? And a lot of it is, in my opinion, about leverage. They just think that to generate these returns, these excess returns, they just want to have a lower coupon, which will raise, like for example, this one. They issue a 10-year bond that has zero coupon, which means after 10 years you get 100 back. It costs 107, and if you take a 5-year bond, you also get zero coupon every year, and you get 100 back after 5 years, and you're paying less to keep your money deprived from you over 5 years than you are paying over 10 years, which is, of course, you can say it's logical, because if after 5 years, if you want to keep losing money, you have to buy another one at 104. So you're kind of saving some money by by buying a 10-year bond. Yeah, kind of silly, but that's kind of how it goes. Some people have talked about coupons going negative, and at that stage you could argue that, of course, logically it would make sense to say that you are paying the government to own the bond, because then the coupon would not flow from the government to the bondholder, but from the bondholder to the government. But in my opinion, even though this 30 will also go to zero if this news article is correct, I don't think the coupons will go below zero, because the banks, when they're buying this bond, they're giving 100, they're getting 100 back after 30 years, and every year they're getting a coupon of 125, which means on the downside they're protected, they get some income, and if they manage to flip it to someone like me, they make a substantial profit. And if you if you take it at zero here, of course they're getting back 100 after 10 years, but they're trying to sell me it for 107. So what I'm saying is that this is like the downside risk, and the upside risk is the price that they can flip it to people like me. So I don't think it will go negative, because at that point I think no one would buy it, not even the banks would be able to buy it. It wouldn't make no sense. And of course you can have like one or two instances where somewhere in the world some government will manage to pull off a negative coupon, and then people will be pointing to it as, it's possible that every bond's going to go negative coupon, and you could have a spike in bond prices again, which of course is silly, but this is all possible. But I think though, logically, when the coupon would go negative, that then the price here would also, it would go below par value. Yeah, that's what I think. So of course now we have to look at where the demand is coming from for these bonds. Of course you can say the speculators who are buying them in the hope that someone else will come in and pay a higher price, and that's that's normal. That's how speculators try to use momentum. But then there's of course the other great source of income, or let's say of sales, for these bonds, is the fund industry. And if I just take this example, I searched here equity euro concentrated, which is of course an equity fund. At least it's advertised as that. You can see that here in this investment policy, it mentions that the fund invests at least 75% of net assets in equities that are in euros, blah blah blah. And then, while complying with the above policies, the sub-fund may also invest in other equities, equity-linked instruments, convertible bonds, money market instruments, blah blah blah, and other funds. So there we go. This is where some of the demand comes from. This is a investment company that is creating these products, but also there's lots of banks that create their own funds that they sell to retail investors. Usually it's clients of their own. They manage to sell them those products. And like when you're going into, into your to meet your advisor at the bank and you ask about funds, they might tell you about an equity fund, and you'll think that it's 100% equities, and they might give you the prospectus. Of course, they should. They should give you all the information you need to make a um, a sound decision and disclose all the potential risks and so on. So of course they'll like give you like the printed prospectus, or they'll send you an email. I don't know exactly. I've never purchased a fund for those reasons, because they have these investment policies that are not kind of what I want my money to be wasted on, and all these entry fees, exit fees, and so on. But anyway, they have to disclose all this, and the people who are, who are lazy, who trust their advisor, they'll go in, they'll buy the fund thinking it's 100% equities, and they'll have a weak performance, or they'll have a strong performance if bonds keep rallying, and that's kind of where the demand is coming from. So yes, it's about all I can say. Leave a comment, subscribe if you want. I might make some more videos if you find them interesting. I prefer having some comments, some discussion, someone telling me that I've got something wrong or something right. Is up to you. Yeah, that's I guess all I have to say about this topic. Have a good day.